And welcome back to Clear Talk, the financial series here on Sacramento Smooth Jazz. And as you know, we take a brief pause from the music, usually about 8 to 10 minutes, to bring you clear and useful information about money. We all need it and we all use it, but we want to be smarter about it. And we have John Nunes of Fortis Insurance Solutions helping us with his nearly 30 years of experience in this industry. And we've been having a great conversation over the last several segments. Now, we also understand that retirement taxes are not driven by one decision. It's usually a series of decisions that help us or hurt us when it comes to taxes. Now, this episode follows the income order discussion. So what happens is that there is a retirement tax trap, and it usually happens when income decisions are made in isolation. Now, John, first of all, welcome back. It's always great to have you. You bring insight, you bring clarity, and you make things simple for our listeners that have been addressing this and contacting you. So welcome back to Clear Talk.
Thanks for having me, Michael. I'm excited to be here.
I'm glad that you're here as well. So, John, in the last segment, you explained why the order of retirement income can matter so much. Today, you want to talk about the hidden tax traps, I believe. So how do those two topics connect for retirees and pre-retirees?
Well, they connect because taxes in retirement it's rarely caused by just one thing. They're usually caused by when you stack income. And when I mean that, I'm talking about Social Security, pensions, IRA withdrawals, required minimum distributions, annuity income, investment gains, or any other type of income. All of those can interact. So the issue here, it's not just how much money that you've accumulated, how much money that somebody has. It's how that money shows up on your tax return and how it affects the rest of the plan.
Now, a lot of people hear the word Social Security, and they assume that is separate from the rest of their retirement tax picture. Why can that be a costly misunderstanding?
Well, it's simple, Michael, because Social Security can become taxable depending on the retiree's overall income picture. Now, that's going to surprise a lot of people because they never expected to hear that. They might be thinking to themselves, you know what, I've already paid into the system, so this shouldn't affect my taxes. But when you do combine Social Security with your IRA withdrawals, potential pension income, investment income, or any other taxable income, part of that benefit may become taxable. Now, that is why your income coordination matters before your withdrawals begin. You don't want to get in that position.
So let's talk about, pivot just a little bit, required minimum distributions. Yeah, also known as RMDs. They're one of those topics that they should pay attention to, but many wait until later to deal with them. I think some people just wait until it's too late. Why can waiting create a problem in this arena?
Simple, Michael, because tax deferred accounts don't stay optional forever. At some point, Michael, many retirees, they got to start taking out their required minimum distributions from certain retirement accounts. Now, what that means is that income can be forced onto the tax return, whether the retiree actually needs the money or not. Now, if your account has grown for decades, those required minimum withdrawals, they're going to affect your tax bracket. They may also affect your Medicare-related costs and the surviving spouse potentially later down the road. So that's why that planning window before your RMDs begin is very valuable. You want to try to eliminate that scenario.
Now, many listeners may understand income taxes, but they may not realize retirement income decisions can also affect Medicare premiums. How should people think about that?
Well, they need to understand that there is certain income decisions that will affect more than just their tax bill. The Medicare premiums that they have could potentially be influenced by their income level. And that really does surprise a lot of retirees. Let's say they have a capital gain, a large distribution, or any other income event that shows up later. So the problem isn't that the income is bad. We need to get that out of the way. It's not bad. The problem is when you're making decisions without measuring the ripple effect. And a tax decision, it should be reviewed for taxes, Medicare, liquidity, and income, not just one piece of the puzzle.
I'm talking with John Nunes, President and CEO of Fortis Insurance Solutions, and this is our Clear Talk segment here on Sacramento Smooth Jazz, where we pause the music for just a few minutes to give some insight and understanding as it relates to income during retirement and how to plan accordingly. So, John, you mentioned before that retirement planning has to protect both spouses, not just the first person to retire. What is the tax issue that couples often overlook?
Well, this is very important, Michael, because the surviving spouse can face a different tax picture. Because, of course, if one Social Security check is going to go away, the pension income is going to change, and the household may eventually file under a different tax status. And at the same time, your IRA balances, your RMDs, or any other income may still remain. So what that means is that the surviving spouse could have less income, but still face a very heavy tax burden. Now, good retirement planning should ask yourselves, what happens to my income and taxes after the first spouse passes away?
So beyond retirement accounts, how can normal investment decisions or cash flow needs create tax issues that people were just not expecting?
Well, for example, if someone does sell an investment to create income, what that may create is capital gains or any other tax consequences. Now, if they sell during a down market, they're also going to lock in losses and potentially reduce the recovery potential of that portfolio. So that's why the cash reserves and reliable income sources really matter. Because what happens here is a retiree shouldn't be forced to sell the wrong asset at the wrong time simply because there was no income plan. And those tax traps and market traps, they often show up together. And that's something that we're going to help try to eliminate.
If someone wants to be proactive, right? What should they review before the year is over or before they make a major retirement income decision?
Well, what they should do is they should estimate the total income for the year, review their Social Security, their pensions, potential IRA withdrawals, annuity income, investment gains, RMD exposure, Medicare-related thresholds, tax withholding, any other liquidity needs. Because what they also need to do is they need to coordinate with a qualified tax professional. And that's the one thing we always stress when it comes to taxes, coordinate with a qualified tax professional. Because our goal here, it's not to avoid paying every dollar of tax. What we're trying to do is we're trying to avoid unnecessary surprises, because we want to make sure that when they make these types of decisions, that it actually fits their income strategy.
Now, the next step, people are listening, they're contacting you, and we have maybe some new listeners today. What should listeners do if they're starting to realize that retirement taxes may be more connected to their income decisions than they thought?
Well, like I've been saying consistently, Michael, do not make any retirement decisions in isolation. Whether you're looking at a withdrawal, a rollover, an annuity decision, Social Security decisions, or any tax strategy, those should be reviewed as part of a whole plan. Now, what we do here at Fortis Insurance Solutions, we actually help people coordinate income, taxes, liquidity, risk, and longevity. So if they visit our website at fortisinsurancesolutions.com, they can actually contact us to schedule a retirement income strategy review, because our whole goal here is to see the traps before they become too expensive.
All right. Now, it's John Nunes, nearly 30 years of experience in this field. He knows what he's talking about. That's why we have him here. This has been another Clear Talk segment. Now, before we go, John, there are some people who just may want to call you direct rather than go to the website. How can they reach you by phone?
They can reach me, Michael, at 1-800-900-3150. That's 1-800-900-3150.
And ladies and gentlemen, if you're on our website right now streaming at sacsmoothjazz.fm, just scroll down. You will see the Clear Talk segment. You'll see also a guide. Click on that. Takes you right over to Fortis Insurance Solutions to help you get your guide, of course, to communicate with John Nunes today. John, always a pleasure having you here. Always appreciate you giving us clarity.
It's always a privilege to be here, Michael. Your listening audience is tremendous. We get a lot of positive responses, a lot of questions. And we're very glad that we're able to actually educate and help your listening audience when they need to make difficult decisions.
Awesome. Awesome indeed. Look forward to speaking with you yet again. This has been another Clear Talk segment right here on Sacramento Smooth Jazz, your escape from the noise.